If you've been having a good year or a bad year in the financial markets, tax loss harvesting might be a good idea to help reduce your overall tax exposure. Think of tax loss harvesting as selling stocks to strategically reduce your taxes. In this video, we're going to be talking about what tax loss harvesting is, the benefits of it, and any rules you might need to know should you decide to execute this strategy for your own personal finances. Let's go. What's going on, everybody? Brian Rivera, CPA, and I want to welcome you to the channel. On this channel, I talk all things entrepreneurship, personal finance, and investing. So if this is your first time, you should consider subscribing. So I don't care who you are, every single person has one thing in common, and that is they want to lower their tax bill. After you exhaust business deductions, charitable contributions, and retirement plans, many investors are left scratching their heads on trying to figure out different ways that they can continue to lower their overall tax exposure. And for many investors, tax loss harvesting is probably one of the most crucial tools in helping reduce that tax bill. You don't have to be some big time portfolio manager, hedge fund manager to reap the benefits of an annual portfolio harvest. So tax loss harvesting is also known as tax loss selling, and usually this strategy is implemented at any point in the year, but most oftentimes you'll see it occur near year end, as that is the time that you have to execute it for any benefit in your current year tax situation. And so coming up here shortly, I'm going to actually share with you a hypothetical example of how this strategy actually works. But before I do that, let's go ahead and get some basic education out of the way so that we can understand exactly what this means. So what is tax loss harvesting? So tax loss harvesting is basically a way to slash your tax bill by selling your investments at a loss and deducting those on your current year tax return. So what an investor is doing is he's scanning his portfolio for any unrealized losses, maybe some losers, some stocks that weren't actually performing, and he's going to take those losses to offset any realized gain. So that's going to be anything that he sold during the year. And by doing that, he's going to reduce that overall tax exposure or that tax bill. Remember, deducting these losses could actually wipe out your entire capital gains tax bill, or at least reduce it. Now, if you get to the point where there is no capital gains income by selling those losers, well, then you can get above that and deduct up to $3,000 against other sources of income. So whether you have a job, W-2, or business, this will reduce it up to $3,000. To drive this point home, I'm going to show you a quick example of maybe a portfolio holding and some trading activity to actually drive the point home on how this strategy actually works. Now, for example, let's just say you're currently holding an unrealized gain of $250,000. You're holding some Tesla stock, you're doing really good, and you had it for at least 420 days. You had Delta Airlines stock, it didn't perform that well this year, you're down $130,000. You also have Intel stock, you're holding that at a $100,000 realized loss, it hasn't been doing too well, and you've been holding that for 125 days. Now let's just say during the year, you decided to sell Apple, you caught it at the bottom, you did great, and you sold that for a $200,000 realized gain. Now you held that longer than 365 days, so now you're in the long-term capital gains tax bracket. And then you also had Netflix at a $150,000 realized gain. That was below 365 days, so you're gonna pay short-term capital gains. So let's take a look at how that tax calculation is gonna look. So without tax loss harvesting, meaning we didn't implement any strategy, we just sold those two positions, that's going to be Apple and that's going to be Netflix. Apple, because that was a long-term capital gains holding, you're going to pay 20% or basically $40,000 on 200 grand of realized gain. On Netflix, because that's short-term and we're assuming you're at the top tax bracket, you're going to be sitting at 37%. So you're going to pay 55 grand on a $150,000 realized gain. So your overall tax bill is going to be $95,500. Now that you see your potential tax exposure is $95,500, you decide, you know what, I don't actually want to pay this. What can I do? You decide to implement tax loss harvesting. So you scanned your portfolio and you saw that you had two losers. You had Delta Airlines and you had Intel. So what you do is you decided to sell Delta to offset your long-term capital gains that you realize on your Apple position. When you look at the net impact of that times the long-term capital gains tax rate of 20%, you're going to be looking at about a $14,000 tax bill. In the same token, you saw Netflix, you sold that for a $150,000 gain. You decide to sell Intel, which is also a short-term position, for a $100,000 loss. You multiply that times the short-term capital gains rate of 37%. Now you're looking at $18,500 of short-term capital gains tax. Add that up, your total tax exposure is now $32,500. Compare that to the $95,500 that you were looking at before. You now have saved yourself $63,000 in tax just by implementing tax loss harvesting. So as you can quickly see in this example, the benefits of tax loss harvesting absolutely helps long-term investors. You're strategically leveraging unrealized losses in your portfolio to offset any realized gains in a given year. So at the end of the day, you're reducing the amount of tax that you may potentially have to pay. So specific to tax loss harvesting, are there any rules or regulations that you need to be aware of? So if you do a quick Control F in the tax code, you won't see any particular mention of tax loss harvesting. However, that does not mean that there are not rules specifically designed to govern this type of strategy. And a matter of fact, a rule was created just for these particular situations. There is something created called the wash sale rule. And so if you sold that investment at a loss and you turned around and bought it within a 30-day window, you now just triggered a wash sale, which gets disallowed for tax purposes, and it gets deferred into the next tax year. So now it just negated this entire strategy that you're trying to employ. So my advice is I would sit it out for 31 days. Don't even touch that same stock. Or if you can scan that sector and you find like a stock that is maybe a competitor or similar industry, then maybe you can do that. Otherwise, just sit it out and wait, let the 31 days pass, so that way you can jump back into that investment that you want to participate in. Now, the other thing to keep in mind with this wash sale rule is that it is substantially identical securities. So if you bought a stock or the option, both of those are looked at as the same. So if you bought Tesla stock and Tesla options, you could trigger a wash sale across those two. Just something to keep in mind. A couple other things that I want you to consider if you're thinking about this strategy. Only do this in taxable accounts. Tax deferred accounts, the goal behind those is for tax-free growth. And so if you're selling losers, there's really no benefit to you because the accounts are growing tax-free. This strategy probably doesn't make sense if you're in a lower tax bracket. The goal here is to save taxes today. So if you feel like you're going to be in a higher tax bracket, maybe wait until then. If you expect to be in a higher tax bracket, maybe you got a promotion at your job, maybe you started a new business and your income took off. This is the times where you want to use these types of strategies so that way you can reduce your overall tax bill. Remember that this strategy needs to be executed before December 31st. If you wait till after that date, it's going to have no impact on your current year tax return. So mark your calendars. I want to execute tax loss harvesting. I need to do it by 12/31 every single tax year. Also, another thing to keep in mind before you get sell happy, the upside to losses is only $3,000 per year. So again, if you're an investor, you can only deduct up to $3,000 of capital losses on your tax return against other income. So if you've had a brutal year in the stock market, no worries, you don't actually lose those losses. You can only recognize $3,000 this year. You carry the rest forward. In the next year, if you have capital income, it'll offset those carryovers. If there's no income, you'll continue to recognize $3,000 per year on your tax return. The other thing I'm going to say is don't sell the positions just to get the tax break. Now, remember, the goal of being an investor is to get returns that beat other asset classes like bonds, savings accounts, things of that nature. So when you're investing in the stock market, you may have to stomach some short-term volatility to get those outsized returns. Unless something has fundamentally changed with the company, that you're investing in, they're filing bankruptcy, they're losing revenue, they sold business unit. There's a ton of things, right? So if something has changed, then maybe you want to start looking at exiting that position. But if nothing has fundamentally changed, maybe there's just some short-term volatility. A lot of times you might be better off just sitting, letting the position ride out and let, time do its thing. Because usually, the stock market is designed to go up. And so a lot of times your returns will smooth out. It's just, you got to stomach that short-term volatility. Lastly, and most importantly, once you sell those positions, it's time to put that cash back to use. Now use that new cash that you just raised to purchase a new position where you think that you'll get some outsized returns, or you can add to an existing winner. All I got for today, guys. If you found value in today's video and you learned a thing or two about tax loss harvesting, tax loss selling, don't forget to hit that like button. And I sincerely wish you guys the best of luck on your investing journey. Have a good one.